Before we begin, please remember that I am not a licensed financial advisor, mortgage broker, or attorney. This presentation is for informational and educational purposes only and should not be considered financial, legal, or investment advice. The home buying process is complex and unique to every individual. Always consult with a qualified professional before making any financial decisions. Let's talk about the moment your dream is about to become a nightmare. You've done everything right. You saved for years, you built your credit score into a fortress, you spent countless weekends dragging yourself through open houses, and you finally found it. The one. You beat out other offers, you navigated the inspection, and your loan was approved. You can already smell the fresh paint, you can picture where the sofa will go. The finish line is right there. Then an email lands in your inbox. It's a document called the closing disclosure. And as you open it, your stomach plummets through the floor. The number at the bottom, the cash to close, is thousands, maybe even $10,000 more than you were told to expect. Your mind starts racing. Where did this number come from? You scroll through a 5-page maze of line items with names like underwriting fee, processing fee, courier fee, tax service fee. It feels like you're being nickel and dimed to death by 1,000 tiny cuts. Panic sets in. Do you have this money? Can you even still buy the house? This exact scenario, this last-minute financial ambush, is the single most stressful and infuriating part of buying a home in America. And I'm here to tell you it is not an accident. It is a feature, not a bug, of a system that profits from your confusion. But that ends today. Right here, right now. In this video, we are going to arm you with the knowledge to fight back. We will pull back the curtain on the murky world of mortgage fees and expose every single trick, trap, and outright scam lenders use to pad their profits at your expense. By the time you're done watching, you will be able to read a loan estimate and a closing disclosure with the precision of a forensic accountant. You will know which fees are legitimate, which are negotiable, and which are pure, unadulterated junk. This isn't just about saving a few $100. This is about saving thousands, potentially tens of thousands of dollars, and reclaiming control over the single biggest purchase of your life. So let's get into it. The first and most important thing to understand is that not all fees are created equal. They fall into 3 categories: legitimate third-party costs, fees the lender is required to collect, and the one we're focused on today, the lender's profit centers. These are the fees they charge you simply for the privilege of giving them your business. And the king of them all, the big boss, is the loan origination fee. You will see this on your loan estimate, usually right at the top in Section A. It sounds official, doesn't it? Origination. It makes you think of some complex, essential process. And that's the point. Lenders want you to think this is a fixed, non-negotiable cost of doing business, like a tax. It is not. The loan origination fee is, in simple terms, the lender's commission. It's their main payday for selling you the loan. This fee is how they pay their loan officers, their marketing department, their overhead, and of course how they generate profit. It's typically calculated as a percentage of the total loan amount, usually somewhere between 0.5% and 1.5%. Now that might not sound like a lot. 1%. What's the big deal? Well, on a $400,000 loan, a 1% origination fee is $4,000. That's $4,000 of pure profit for the bank, coming directly out of your pocket at closing. And here's the secret. It is almost always negotiable. When a loan officer tells you, "Oh, our standard origination fee is 1%, what you should hear is, "My opening offer is 1%. You have to remember, especially in a competitive market, lenders are fighting for your business. They want your loan. A competing bank or credit union down the street might be willing to do the exact same loan for a 0.5% fee, or even with no origination fee at all. Getting multiple loan estimates from different lenders isn't just a good idea. It is your single most powerful weapon. When you have an estimate from lender B that shows a lower origination fee, you can go back to lender A and say, "I'd love to work with you, but your competitor is offering me the same rate and their origination fee is $2,000 less. Can you match that?" More often than not, they will, because losing $2,000 in profit is a lot better than losing your entire loan, which is worth far more to them over the next 30 years. Never, ever accept the first origination fee you're quoted without a fight. Now, tied directly to this is the second most misunderstood and abused fee on the list, discount points. This is another item you'll find in Section A of your loan estimate, right next to the origination fee. And this is where things get really tricky. A discount point is a fee you pay up front to the lender in exchange for a lower interest rate on your loan. 1 point typically costs 1% of your total loan amount and will usually reduce your interest rate by about 0.25%. So, on that same $400,000 loan, 1 discount point would cost you $4,000 at closing. In exchange, your interest rate might drop from, say, 7.0% to 6.75%. The lender will sell this to you as a fantastic investment. They'll say, look, you pay a little more now, but you'll save a ton of money over the 30-year life of the loan because your monthly payment will be lower. And mathematically, over 30 years they are correct. But this is a classic case of using a sliver of truth to sell you a very expensive product you might not need. The only question that matters when considering discount points is this: how long will it take for the monthly savings to pay back the upfront cost? This is called the break-even point. Let's do the math. On our $400,000 loan, going from 7% to 6.75% would lower your monthly principal and interest payment by about $70. You paid $4,000 upfront for that discount point. So you divide $4,000 by your monthly savings of $70. The answer is about 57 months. That's almost 5 years. You will have to stay in that house with that same mortgage for nearly 5 years just to break even on the $4,000 you paid upfront. Only after month 57 do you actually start saving money. So you have to ask yourself honestly, are you absolutely certain you'll be in this house for more than 5 years? The average American homeowner moves every 7 to 10 years. If you think there's any chance you might sell the house or refinance the loan within that break-even period, paying for discount points is like setting a pile of cash on fire. You are literally just giving the bank thousands of dollars of extra profit for absolutely no benefit to you. And here's the even darker side of points. Sometimes you'll see a negative number in the points column. This is called a lender credit. This is the opposite of a discount point. The lender gives you money to be applied toward your closing costs, but in exchange, you take a higher interest rate. This can seem incredibly tempting, especially if you're short on cash for closing. The lender might say, hey, we can give you a $3,000 credit and slash your closing costs if you just take a 7.25% rate instead of 7%. But that slightly higher rate will cost you tens of thousands of extra dollars in interest over the life of the loan. It's a short-term solution that creates a massive long-term problem. They are essentially letting you finance your closing costs at an exorbitant interest rate. Unless it is an absolute emergency and the only possible way you can close on the house, you should avoid lender credits like the plague. So already, just by understanding these first two fees, the origination fee and discount points, you've moved from being a passive victim to an active, informed negotiator. You now know that the lender's commission is up for grabs and that paying for a lower rate is a gamble that only pays off if you stay put for years. But believe me, we are just getting started. These are the big, obvious fees. The truly insidious ones are the smaller charges, the ones that look like legitimate administrative costs, buried in the alphabet soup of section B on your loan estimate. These are the fees with innocent-sounding names that are pure 100% junk, and we're going to expose them next. Let's start with the classic, the one that feels the most normal, the application fee. It sounds reasonable, right? You're applying for a massive loan, of course there's a fee. They'll tell you it's to cover the cost of running your credit and starting the paperwork. This is financial sleight of hand. The cost to pull your credit report is minimal, maybe 20 to 50 bucks, and it's already covered by another fee we'll get to, the credit report fee. So what is the application fee? It's the cover charge to a club you were already invited to. It's a fee for the privilege of giving them your business. In today's competitive market, most reputable lenders have done away with this. If you see an application fee for a few $100s on your loan estimate, your first question should be, can you waive this? If they say no, it's a giant red flag that they're going to nickel and dime you all the way to closing. Next on our hit list is the tag team duo of deception, the processing fee and the underwriting fee. These are the two most common junk fees in the entire mortgage industry. The lender will tell you the processing fee is for the processor, the person who gathers all your documents, your pay stubs, your bank statements, your tax returns, and puts them into a neat little package. Then they'll say the underwriting fee is for the underwriter, the person who actually analyzes that package and makes the final decision to approve or deny your loan. Here's the truth. The processor and the underwriter are salaried employees of the lender. Their pay is part of the lender's cost of doing business. It's like going to a restaurant and getting a bill with a chef fee and a server fee, in addition to the price of your meal. It's outrageous. The lender's profit, the money they make for doing their job, is supposed to come from the interest rate they charge you over the life of the loan, or from the origination fee, which is a percentage of the loan amount. Charging you separate fees for processing and underwriting is pure double dipping. They are charging you for their own payroll. So when you see these fees, often ranging from $400 to over $1,000 each, you need to push back. You can say, I understand these are your costs of doing business, but I'm comparing loan estimates with other lenders who don't charge these as separate line items. Can these be waived or absorbed into the origination fee? This shows them you know the game. Sometimes they'll magically disappear. Other times they'll reduce them. But if they stand firm, you know you're dealing with a lender whose business model is built on padding their profits with bogus fees. Now let's talk about a fee that sounds incredibly official. The document preparation fee. This one preys on your imagination. You picture a team of lawyers in a high-rise office, meticulously crafting hundreds of pages of legal documents just for you. The reality? It's a computer program. They plug your name, your address, and your loan number into a software template, and it spits out a standardized stack of papers. The human effort involved is minimal. Charging you $200, $300, or even $500 for this is like an airline charging you a printing fee for your boarding pass. It's an absurdly inflated charge for a completely automated process. This fee is almost always pure junk and highly negotiable. Let's move on to my personal favorite, because it's so outdated it's almost laughable: the courier fee. This is a charge, maybe $50 to $100, for transporting documents back and forth between the lender, the title company, and the county recorder's office. In 1995, this made sense. You had a guy in a car literally driving paper across town. But today, we live in the age of email, e-signatures, and secure digital portals. The vast majority of documents are sent electronically. The wire transfers are digital. Yet, this phantom fee persists on loan estimates like a ghost of mortgages past. It's a cash grab hiding in plain sight. If you see a courier fee, question it immediately. Ask them, what specific physical documents are being couriered that cannot be sent electronically, and why is the cost so high? Watch them squirm. More often than not, they can't give you a straight answer, and the fee can be easily removed. Right alongside it, you'll often find a wire transfer fee. Again, this sounds legitimate. Money is being moved, so there must be a cost. And yes, banks do charge for wire transfers, but it's usually a flat fee of around $25 to $30. So why is your lender charging you $50, $75, or even $100? Because they're marking it up. They're taking a standard banking cost and turning it into a tiny profit center for themselves. It's not a huge amount of money in the grand scheme of your mortgage, and that's exactly what they're counting on. They know you won't fight over $50 when you're borrowing hundreds of thousands. But it's the principle. It's a clear indicator of a lender's philosophy. Profit on everything, even the basics. Now for the king of all junk fees, the master of ambiguity, the administrative fee. This is the ultimate catch-all. It has no defined purpose. It's just a fee. For administration. What administration? They'll never tell you. They can't because it doesn't exist. It's not for processing. It's not for underwriting. It's not for documents. It's simply a miscellaneous charge they slap on the bill because they can. It's the financial equivalent of a "because I said so" fee. If you see an administrative fee on your loan estimate, you should view it as a direct challenge. It is the most blatant, unapologetic junk fee of them all. There is zero justification for it, and you should demand its immediate removal. There is no service attached to it. It is 100% pure lender profit, and you should not pay it. Finally, let's touch on a tricky one: the rate lock fee. This one is complicated because sometimes it's legitimate, and sometimes it's not. A rate lock protects you from interest rates going up between the time you apply and the time you close. Typically, lenders will offer a free 30 or 45-day rate lock. It's part of the package, but some will try to charge you a fee for this standard service. That's junk. Where it gets legitimate is if you need an unusually long lock, say 90 or 120 days, maybe for a new construction home that isn't finished yet. In that case, the lender is taking on more risk and a fee can be justified. But if you're on a standard 30-day closing and they're trying to charge you a half point or a flat fee just to lock your rate, they're playing games. They're manufacturing a sense of urgency and charging you to solve a problem that shouldn't exist in the first place. All of these fees, application, processing, underwriting, document prep, courier, administrative, they all have one thing in common. They are designed to look like unavoidable third-party costs of doing business. But they are not. They are direct payments into the lender's pocket, over and above the money they are already making from your loan. They are a test to see if you are paying attention. By questioning them, you're not just saving a few hundred or even a few $1,000s. You're sending a powerful message to your loan officer. I am an educated consumer. I will not be taken advantage of. And that message changes the entire dynamic of the negotiation. But as shady as these junk fees are, they are often small enough that people just sigh and pay them. The real danger, the one that can cost you tens of thousands of dollars over the life of your loan, isn't hidden in these little line items. It's hidden in plain sight, in the biggest numbers on the page. It's a fundamental misunderstanding of how interest rates and closing costs are supposed to work, and it's where lenders make their real money. And that's where we're going next. So how do they do it? How do they use the biggest, most attractive number on the entire loan estimate, the interest rate, to hide thousands, sometimes tens of thousands of dollars in costs? They prey on a simple, universal human desire. We all want the lowest number. When you're shopping for a mortgage, your brain is hardwired to hunt for the lowest interest rate. A 6.5% rate just feels infinitely better than a 6.875% rate. Lenders know this. They've built their entire pricing strategy around this psychological quirk. They will dangle an impossibly low rate in front of you, knowing you'll fixate on it, blinded to the trap that's connected to it. This trap is a concept called points. And if you only learn one thing from this entire series, this needs to be it. Understanding points is the difference between getting a great deal and getting completely fleeced. Let's imagine you're buying a $400,000 house. You get two offers. Lender A offers you a fantastic rate of 6.5%. Lender B offers you a rate of 6.875%. Instinctively, you and just about everyone else on the planet would gravitate toward Lender A. That 6.5% looks like a clear winner. But then you look at the closing cost. Lender A, with the lower rate, has $12,000 in closing costs. Lender B, with the higher rate, only has $4,000 in closing costs. Suddenly, the choice isn't so simple. What's going on here? The $8,000 difference is almost certainly due to points. So what is a point? In the mortgage world, 1 point is always equal to 1% of the total loan amount. So on our $400,000 loan, 1 point is $4,000. Simple enough. But here's where it gets tricky. There are two different kinds of points, and lenders love to blur the lines between them. First, you have origination points. Think of this as the lender's basic fee for doing the work, for creating or originating the loan. It's part of their profit. They might charge you 1 point or $4,000 just for the privilege of doing business with them. It's a direct upfront fee. But then you have the second, more complicated type, discount points. This is the one you need to watch like a hawk. Discount points are essentially prepaid interest. You are paying a lump sum of cash at closing today, in exchange for the lender giving you a lower interest rate for the life of the loan. You are buying down the rate. So in our example, Lender A is likely charging you 2 discount points. That's 2% of $400,000 or $8,000 to get you that sweet-looking 6.5% rate. Lender B isn't charging you any discount points, so your rate is higher at 6.875%, but your upfront cost is $8,000 cheaper. The question is no longer which rate is lower. The real question is it worth paying $8,000 today to get that lower rate? This is the question most homebuyers fail to ask. They see the low rate, they get excited about the lower monthly payment, and they sign on the dotted line without ever doing the math. And this is the lender's game. They are betting you won't do the math. They are betting that the psychological pull of that low rate is so strong, you'll gladly hand over thousands of extra dollars at the closing table without a second thought. So let's do the math they hope you'll skip. Let's calculate the break-even point. On our $400,000 loan, the monthly principal and interest payment at 6.875%, that's Lender B's offer with no points, is roughly $2,628. The monthly payment at 6.5%, Lender A's offer, is $2,528. That's a difference of exactly $100 per month. You save $100 every single month by going with the lower rate. Sounds great, right? But remember, you had to pay $8,000 up front to get that savings. So the break-even calculation is simple. You take the total cost of the points, $8,000, and you divide it by your monthly savings, $100. 8,000 divided by 100 is 80. What does 80 mean? It means it will take you 80 months to break even on your investment. 80 months is 6 years and 8 months. You will not save a single penny from that lower interest rate until you have been in that house, making that mortgage payment for almost 7 years. For the first 80 months, all you're doing is slowly paying yourself back the $8,000 you gave to the bank at closing. Now you have to ask yourself a very serious, honest question. Are you positive you will be in this home with this exact same loan for more than 7 years? The national average for how long someone stays in their home before moving is around 8 to 10 years. But for first-time buyers, it's often much shorter, closer to 5 or 6 years. And this doesn't even account for refinancing. If rates drop significantly in 3 years, are you going to refinance into a new loan? Of course you are. If you sell or refinance your home in year 5, that's 60 months, you will have paid $8,000 for a benefit that only paid you back $6,000. You will have lost $2,000. You essentially gave the lender a $2,000 interest-free loan that you never got back. You would have been far, far better off taking the higher 6.875% rate and keeping that $8,000 in your pocket. You could have used it for furniture, for repairs, or just kept it in your emergency fund. This is the hidden genius of the lender's strategy. They get a huge chunk of their profit guaranteed upfront in cash. They know that a huge percentage of borrowers will move or refinance long before their break-even point, meaning all that money paid for points becomes pure, unadulterated profit for the bank. You paid for a 30-year benefit but only used it for 5 years. Now you might be thinking, wait a minute, isn't this what the APR is for? And you're right in theory. The annual percentage rate, or APR, was created by the federal government for this exact reason. It's supposed to be the great equalizer. The APR takes your interest rate and factors in the costs and fees, like points, and expresses the true cost of the loan as a percentage. So, in our example, the loan with a 6.5% interest rate but $8,000 in points would have a much higher APR, closer to the other loan's rate, because the APR accounts for that upfront cost. But the APR has a fatal flaw. The calculation assumes you will keep your loan for the full 30 years. It amortizes the cost of those points over the entire 360-month term. As we've just established, almost nobody does that. So while the APR is a useful tool for a quick comparison, it doesn't tell you the most important thing: your personal break-even point based on how long you actually plan to have the loan. So what's the takeaway here? When you get a loan estimate, ignore the siren song of the interest rate. The first thing you should do is look at Section A, the origination charges. See how much they're charging you in points. If it's more than 0, you need to do the break-even calculation. Ask the lender, if I paid 0 points, what would my interest rate be? Get the 2 quotes, compare the monthly payments, and then divide the cost of the points by the monthly savings. If the break-even point is, say, 3 or 4 years, and you are absolutely certain this is your forever home and you won't refinance, then maybe paying points makes sense. But if the break-even is 7, 8, or 10 years out, you are taking a massive gamble. You're betting against life happening. You're betting against a job relocation, a growing family, a market downturn, or a drop in interest rates. And it's a bet that the lender is happy to take, because they win far more often than they lose. The interest rate isn't the price of the loan. It's a component of the price. The real price is the combination of the rate and the fees you pay to get it. And the most expensive, most deceptive fee of all is often the one you volunteer to pay, seduced by a number that was designed from the very beginning to mislead you. But this is just the beginning of the games played in the closing costs. The points are the big-ticket item, but there's a whole minefield of smaller, ancillary fees that can add up to thousands. They have official-sounding names, they look non-negotiable, and they are designed to bleed you by $100 here, $300 there. And we're going to expose every single one of them. Let's start with the classic, the one you see on almost every loan estimate, sitting there looking all innocent, the application fee. This is the velvet rope charge, the cover fee to get into the club. The lender will tell you this covers the initial cost of pulling your credit report and starting your file. It sounds reasonable, right? They're doing work, they should get paid. Wrong. This is often the first test. They're seeing if you're paying attention. A credit report costs the lender about $30 to $50. But an application fee? I've seen them range from $75 all the way up to $500. The difference is pure, unadulterated profit for the lender. It's their way of getting you to put some skin in the game, to make you feel financially committed to them before they've even done any real work. Think about it. You go to a restaurant, you don't pay a menu reading fee. You go to a car dealership, you don't pay a test drive fee. The cost of acquiring a customer is a normal business expense. But in the mortgage world, they've convinced us to pay them for the privilege of asking them for a loan. Here's the secret. Many highly competitive lenders have done away with this fee entirely. If you see an application fee on your loan estimate, your first question should be, Can you waive this? If they say no, your follow-up is, okay, can you provide an itemized breakdown of what this $500 fee actually covers? Watch them squirm. Often, just by asking, you'll see that fee magically get reduced or disappear entirely. They're banking on you not asking. Next up is the devious cousin of the application fee, the processing fee. This one is even more outrageous. The lender's justification is that this fee pays the salary of the loan processor, the person who gathers your documents, your pay stubs, your bank statements, your tax returns, and puts them into a neat little package for the underwriter. Let me ask you a question. When you buy a cheeseburger, do you get a separate line item on your bill for a grill operator fee? Or a cashier's salary fee? Of course not. That's insane. The cost of the employee's salary is built into the price of the product. It's the cost of doing business. A loan processor's salary is a non-negotiable part of a lender's overhead. They cannot function without them. Charging you a separate processing fee, which can run from $300 to over $1,000, is nothing short of double-dipping. They are charging you for their own payroll. It's a blatant profit-padding maneuver disguised as a legitimate operational cost. When you see this fee, you need to push back hard. You can say, I understand the processor needs to be paid, but that's an operational cost for your company. I'm already paying for the loan through the interest rate and origination charges. This processing fee seems redundant. Again, many of the best lenders have absorbed this cost. If your lender is charging it, it tells you something about their business model. They are a la carting you to death. Now for the big one. The one that sounds so official, so important, that most people never even think to question it, the underwriting fee. This fee can be substantial, often ranging from $600 to $1,500. The underwriter is the final decision maker. They are the judge and jury of your financial life. They review your entire file, your credit, your income, your assets, the property appraisal, and they give the final thumbs up or thumbs down on your loan. Their job is critical. There is no loan without an underwriter. And that is precisely why you should not be paying a separate fee for it. The underwriter is the most fundamental role in the lending institution. Charging a separate underwriting fee is like an airline charging you a pilot fee on top of your ticket price. It's ludicrous. The entire business model of a mortgage lender is predicated on the function of underwriting loans. It is the business. The profit they make from the loan, either through the interest rate spread or the origination charge, is supposed to cover the underwriter's salary and the company's risk. When they tack on a separate underwriting fee, they are breaking out their single most essential cost of doing business and making you pay for it directly. It's the ultimate junk fee, hiding in plain sight behind a veil of importance. You must challenge this. Ask them, isn't the cost of underwriting a core part of your business overhead, which should be covered by the rate and origination points I'm already paying? This question shows you know the game. It shows you know that this isn't a pass-through cost like an appraisal. This is a direct charge for their own internal operations. More often than not, this is a negotiable fee, but only for the people who are bold enough to call them on it. Let's move on to some of the smaller, but equally infuriating fees. They're like piranhas, each one taking a small bite until you've been stripped clean. First, the document preparation fee. In the year 2024, this is one of the most laughable fees in existence. The lender will tell you this fee, typically $100 to $300, is for the cost of preparing your final loan documents for closing. Decades ago, this might have involved a paralegal manually typing out dozens of pages of complex legal forms. But today, your loan documents are generated by a software program. Someone enters your name, loan amount, and property address into a computer, and the software auto-populates a standardized, 100-page template. The preparation takes about 5 minutes of clicking. It is almost entirely automated. Charging a separate fee for this is like your cell phone provider charging you a dialing fee every time you make a call. The technology to do this is a basic sunk cost for the lender. It's not a per loan expense they are incurring. It is a 100% profit fee. Don't fall for it. And how about the courier fee or the wire transfer fee? This is another relic of a bygone era that lenders still love to charge. They'll hit you with a $50 or $100 fee to courier documents to the title company, or to wire the funds for your loan. In reality, most documents are now sent electronically and securely for fractions of a penny, and a wire transfer, while not free for the bank, certainly doesn't cost them $100. It's typically a $20 to $30 flat fee they pay, and they mark it up by 200 or 300% and pass that profit on to you. When you see this, question it. Ask if documents can be e-signed or sent via a secure digital portal. Ask for the actual receipt for the wire transfer cost. The point isn't just to save $50. The point is to send a clear message to your lender. I am watching every single line item, and I will not be a source of easy profit for you. This vigilance sets the tone for the entire negotiation. Finally, we have the king of all vague charges, the administrative fee. If you see this on your loan estimate, a giant red flag should go up. This fee has no purpose. It has no definition. It is, by its very nature, a junk fee. It's a catch-all bucket for the lender to squeeze another $200 out of you. When you ask what it's for, you'll get a flurry of word salad about file retention, internal auditing, or general overhead. It's nonsense. All of those things are, once again, the fundamental costs of being in business. They might as well charge you a keeping the lights on fee. This is the laziest of all the junk fees, and you should have a zero-tolerance policy for it. If you see an administrative fee, you tell them point-blank to remove it. There is no justification for it, and it's a sign of a lender who isn't even trying to hide the fact that they're padding the bill. These fees, the application, the processing, the underwriting, the doc prep, the courier, the admin fee, they are the death by 1,000 cuts. Individually, they might seem small enough to ignore. $100 here, $300 there. But together, they can easily add up to $2,000 or $3,000 in pure lender profit that you do not have to pay. But as infuriating and as costly as these junk fees are, they are just the opening act. They are designed to distract you, to wear you down, while the real money is being made somewhere else on your loan estimate. There is one section, just a few little boxes, that holds the key to the lender's real profit in your biggest potential cost. It's where they hide commissions, manipulate rates, and can cost you not just thousands at closing, but tens of thousands over the life of your loan. And we are diving into that next. This entire game revolves around one central concept that most homebuyers never hear about: the par interest rate. Think of the par rate as the true baseline interest rate for that day, for your specific financial profile. It's the rate at which the bank makes its standard, acceptable profit without charging you any extra fees to get it, and without giving you any credits to take it. It's the 0 point, the starting line. But you will almost never be offered the par rate up front. Why? Because the real money, the real manipulation, happens when the lender moves you off of that par rate, either above it or below it. Let's imagine two neighbors, Dave and Sarah. They're buying identical houses for the same price on the same day. They have identical credit scores and incomes. They even go to the exact same loan officer at the exact same bank. A few weeks later, they're chatting over the fence. Dave says he locked in a great interest rate of 6.75%. Sarah is shocked. She says her rate from the very same lender is 7.25%. Dave feels smug, thinking he got a much better deal. But then Sarah mentions that the lender paid for almost all of her closing costs, and she only had to bring a few $1,000s to the table. Suddenly, Dave's face drops. He had to scrape together an extra $8,000 in cash for his closing costs to get that lower rate. So who actually got the better deal? The answer is complicated, and it exposes the entire shell game of mortgage pricing. Let's start with Dave's situation. He paid for a lower rate. This is done through something called discount points. 1 point is equal to 1% of the total loan amount. So on a $400,000 loan, 1 point costs $4,000. Dave, wanting the lowest possible monthly payment, paid 2 points or $8,000 cash at closing to buy down his interest rate from the par rate of, let's say, 7% down to 6.75%. The lender loves this. They get a huge chunk of their profit paid to them upfront in cash. It's guaranteed money for them. For Dave, the math on whether this was a good idea comes down to one thing: the break-even point. Let's do the math. A $400,000 loan at the 7% par rate has a principal and interest payment of about $2,661 per month. At Dave's 6.75% rate, his payment is $2,594. That's a savings of $67 a month. Now, he paid $8,000 to get that savings. So, to figure out his break-even point, we divide the cost, $8,000, by the monthly savings, $67. The result is $119. That means it will take Dave 119 months, or just under 10 years, just to break even on the money he paid up front. If Dave sells or refinances the house in year 9, he will have literally lost money on the deal. He handed the bank thousands of dollars for a benefit he never fully realized. He only starts actually saving money in year 10. So if Dave plans to live in that house for 30 years, paying points was a brilliant move. If he's likely to move in 5 to 7 years, it was a terrible financial decision. Now let's look at Sarah. She did the exact opposite. She willingly took a higher interest rate than the par rate. She took 7.25% when the par rate was 7%. Why on earth would she do that? Because of the lender's hidden profit engine, what used to be called the yield spread premium. When a lender originates a loan at an above-par interest rate, that loan is more valuable to investors on the secondary market, where mortgages are bought and sold. A 7.25% loan is going to generate more income over its lifetime than a 7% loan, so an investor is willing to pay the original lender a premium, a bonus, to buy it from them. The lender then takes a piece of that bonus and gives it back to the borrower, Sarah, as a lender credit. This credit can be used to pay for her closing costs, the appraisal fee, the title insurance, the processing fees, all of it. In this case, the lender might have given Sarah a credit of $7,000. For Sarah, who was short on cash, this felt like a miracle. A no closing cost loan. But there is no such thing as a free lunch. Sarah's monthly payment at 7.25% is $2,728. That's $67 more than the par rate payment, and a whopping $134 more than Dave's payment. Let's look at the long-term cost. Over 30 years, Sarah will pay nearly $29,000 more in interest than if she had just taken the 7% par rate. And she'll pay over $48,000 more than Dave. She avoided a $7,000 upfront cost, but she's paying for it with a $48,000 long-term expense. This is how people end up house poor. They focus so much on the upfront cash that they sign up for a higher monthly payment that bleeds them dry for decades. So who is pushing these different options? The loan officer. And here's the dirtiest secret of all. Their incentives are not always aligned with yours. Many loan officers are paid a commission based on the revenue of the loan. A loan with a higher interest rate, the one Sarah took, generates a larger yield spread premium for the bank, making it a more profitable loan. Therefore, the loan officer's commission on Sarah's loan is likely higher than it is on Dave's. They have a direct financial incentive to steer you towards a higher interest rate. They'll frame it as a gift. I can get you a credit to cover all your closing costs. They won't tell you that this gift is costing you $50,000 over the next 30 years and padding their own paycheck. On the flip side, if a loan officer is trying to win your business by advertising an unbelievably low rate, know that they are going to make up for it by charging you a mountain of points at the closing table. The interest rate you are quoted is not a fixed, take it or leave it number. It is a sliding scale, and you are in the driver's seat, but only if you know how to drive. The single most powerful question you can ask a lender is this: can you please show me your rate sheet for today? Or more simply, what is your par rate? And what are the costs for a rate 1/8 and 1/4% below par? And what are the credits for a rate 1/8 and 1/4% above par? This question instantly signals that you know the game. It transforms you from a passive price taker into an active negotiator. It forces them to lay all their cards on the table, revealing the true cost of buying down the rate and the true credit you should receive for taking a higher one. You get to decide what makes sense for you. Are you like Dave, planning to stay forever and want the lowest payment possible? Then maybe paying points is the right call. Or are you like Sarah, short on cash and you only plan to be in the house for 3 years before your job transfers you? In that case, taking the higher rate and the lender credit is absolutely the smarter financial move. There is no single best deal. There is only the best deal for you. But you can't get the best deal if you don't know the game is even being played. We've just cracked the code on how rates and points are priced, the single biggest factor in your long-term mortgage cost. But the lender has another, more immediate way to pull money out of your pocket. It's a document filled with a minefield of junk fees, padded costs, and redundant charges, all designed to overwhelm and confuse you at the moment you're most vulnerable. It's called the loan estimate, and next we are going to tear it apart line by line so you can spot every single inflated charge and fight back. This 3-page document is your financial battleground. It looks official, it feels final, but I'm telling you right now, it is a proposal. It's the lender's opening offer, and it's filled with soft spots, bloated numbers, and outright junk fees they hope you'll be too overwhelmed to question. They are counting on your confusion. But by the end of this, you won't be confused. You'll be armed. Let's start at the top of page 1. You'll see the date it was issued, your name, the property address. Basic stuff. But right below that, you see the loan terms. This is the heart of the deal. You've got the loan amount, the interest rate, and the monthly principal and interest. Now, here is the first critical tripwire. Look closely next to the interest rate. Does it say yes or no next to the word locked? If it says no, that beautiful low rate they quoted you is pure fantasy. It's a marketing number. It means nothing. That rate can and likely will change unless you have a signed rate lock agreement. A no here is a massive red flag that you're being baited. The rate isn't real until it's locked. Next, you see projected payments. This is designed to look like your total monthly payment, but it's often an underestimation, a little white lie to make the payment look more affordable. It breaks down principal and interest, which is fixed, but then it adds mortgage insurance and estimated escrow. That word estimated is doing some very heavy lifting. This escrow number is their guess for your property taxes and your homeowner's insurance. Lenders have a nasty habit of lowballing this estimate. Why? Because a lower total monthly payment makes you more likely to sign on the dotted line. The problem is, the tax authority and the insurance company don't care about their estimate. They want the real amount. And when the real bills come due and your escrow account is short, the lender will pay it. But then they'll hit you with a massive increase in your monthly payment next year to cover the shortage. It's called an escrow shortage, and it's a brutal surprise for millions of new homeowners. Scrutinize this number. Do your own research. Call the county tax assessor's office and get a real insurance quote to see how close their estimate actually is. Finally, at the bottom of page 1 you have costs at closing. You'll see two big numbers: estimated closing costs and estimated cash to close. They are not the same thing. Estimated closing costs are the total fees for the loan itself. Estimated cash to close is what you actually need to bring to the closing table. It's the closing costs plus your down payment, minus any deposits you've already paid. This is the number that matters. This is the check you have to write. This is the figure that needs to match the money in your bank account. Now let's flip to page 2. This is where the real magic and the real mischief happens. This is the detailed breakdown of those estimated closing costs. It's a jungle of line items and we're going to hack through it. Look at section A, origination charges. Let me be perfectly clear. This entire section is 100% pure profit for the lender. Every single dollar here goes directly into their pocket. This is not a pass-through cost for a service someone else is providing. This is their paycheck for giving you the loan. And because it's their paycheck, it is the most negotiable section on this entire form. You'll see a line for points. This is a percentage of the loan amount you can pay up front to buy down your interest rate. Sometimes this makes sense, especially if you plan to be in the home for a very long time. But often, it's a way for lenders to advertise an artificially low rate. They'll quote you a 6.5% rate, but the loan estimate shows you're paying 2 points or 2% of the loan amount just to get it. That's an extra $6,000 on a $300,000 loan. Always ask for a quote with 0 points so you can see the lender's true, unsubsidized interest rate. Then you see the junk drawer: application fee, underwriting fee, processing fee, administration fee. What is the difference between processing and underwriting and administration? Absolutely nothing. It's like a restaurant charging you a chef fee, a cooking fee, and a kitchen gas fee on top of the price of your steak. It's absurd. These are all just names for the cost of doing the loan. Lenders will often break one large origination fee into 3 or 4 smaller sounding fees because a $250 processing fee sounds a lot more reasonable than a $1,000 origination fee. But it's the total of Section A that matters. Add it all up. If that number seems high, typically more than 1% of your loan amount, you need to push back. You can literally say, your competitor is offering the same rate, but their total origination charges are $500 less. Can you match that? They can, and they often will. Now for Section B, services you cannot shop for. This sounds rigid, non-negotiable. And that's exactly what they want you to think. These are third-party services the lender orders on your behalf. You can't pick the provider, but you can, and you must question the cost. The first one is the appraisal fee. This is what you pay a licensed appraiser to confirm the house is worth what you're paying for it. This fee can range from $400 to over $1,000 depending on your location and the complexity of the property. The red flag here isn't the fee itself, but the markup. The lender hires the appraiser, but some will add their own secret surcharge on top. If the appraiser charges $500, the lender might bill you $650. It's illegal, but it happens. If the fee on your estimate seems high for your area, demand to see the appraiser's actual invoice at closing. You have a right to see it. Next, the credit report fee. This should be minimal, maybe $30 to $60. This is the cost for the lender to pull your credit history from the 3 major bureaus: Some lenders, however, will inflate this to $100 or more. It's a small amount, but it's a matter of principle. It's a sneaky way to pad their profits. Question it. You'll also see things like a flood certification fee. This is a third-party company telling the lender whether your property is in a flood zone. This is usually a $20 fee. If you see $100, they are ripping you off. The theme for Section B is this. These are legitimate costs, but they are ripe for illegal markups. The lender is acting as a middleman, and you need to make sure they aren't secretly skimming off the top. Now we arrive at Section C, services you can shop for. This is where you can save serious money. This is where the lender's control ends and your power begins. They are legally required to give you a list of providers for these services, but you are not required to use any of them. In fact, you shouldn't. The list they provide is often made up of companies they have cozy relationships with, not the ones that will give you the best price. The biggest line item here by far is title services. This is a cascade of fees: settlement or closing fee, lender's title insurance, and sometimes a title search fee. Let me demystify this. Title insurance protects the lender in case there's some ancient claim or lien on your property's title from a previous owner. The settlement agent is the person, usually an attorney or a title company, who handles the paperwork and facilitates the closing. These fees can easily run into thousands of dollars. And here's the secret. The price for these exact same services can vary by hundreds, even thousands of dollars, from one title company to another. You absolutely must shop around. Get quotes from at least 3 different title companies or real estate attorneys in your area. Tell them you're shopping your title services from a loan estimate and ask for their fee sheet. The savings you can find in this one section alone can be the single biggest cost reduction you make in the entire home buying process. Don't just accept the lender's preferred partner. That is a rookie mistake that will cost you dearly. We've just cracked open the lender's playbook on pages 1 and 2, exposing the junk fees and hidden markups in sections A, B, and C. But we haven't even touched the government fees, the prepaids, or the other costs that make up that giant cash-to-close number. And lurking within those sections is a fee so sneaky, so often misunderstood, that it can legally change at the last minute and completely blow up your budget. It's the lender's secret weapon for last-minute profit, and we're exposing it next. This hidden charge is called a discount point, and if you've ever shopped for a mortgage, you've seen it. It's the price you pay to get a lower interest rate. 1 point equals 1% of your loan amount. So on a $400,000 loan, 1 point costs you $4,000 paid upfront at closing. Lenders will present you with a menu of options. You can take a 6.75% interest rate for 0 points, or you could pay 1 point for $1,000 to get a 6.5% rate. Or maybe pay 2 points, $8,000 to get a 6.25% rate. Feels like a choice. Feels like you're in control. But this is the trap. Because what most lenders don't scream from the rooftops is that the price of that interest rate isn't fixed until you formally lock it in. The loan estimate they give you at the beginning is just a snapshot in time. A picture of what the rates cost on that specific Tuesday at 11 a.m. By Wednesday, the entire menu could have changed. And if you haven't locked your rate, you are completely exposed to the whims of the market. And that's when the last-minute phone call comes. Let's talk about a couple, we'll call them James and Maria. They were buying their first home, a perfect little starter house with a yard for their dog. They found a lender who offered them a fantastic deal. A 6.5% interest rate at a cost of just half a discount point. On their $350,000 loan, that was only $1,750. It fit perfectly in their budget. They were ecstatic. They signed the initial disclosures, paid for the appraisal, paid for the home inspection, and spent the next 3 weeks dreaming about paint colors and where to put the sofa. They were emotionally and financially all in. 10 days before their scheduled closing date, their loan officer calls. The tone of his voice is different. He tells them there's been some market volatility. Some inflation news came out, the bond market got spooked, and the cost of their rate has changed. To keep that same 6.5% interest rate, it was no longer going to cost half a point. It was now going to cost 2 full points. A $7,000 fee. Their closing costs had just jumped by over $5,000 overnight. James and Maria were in shock. They felt cornered. The loan officer presented their options. They could either scramble to come up with an extra $5,000 they didn't really have, or they could abandon the 6.5% rate and instead take a new, higher rate of 6.875% for the original half-point cost. A higher rate that would mean a higher monthly payment for the next 30 years. They had a week to decide. They had already given notice on their apartment. The moving truck was booked. The seller of their new home was already packing. Backing out wasn't an option. They'd lose their earnest money deposit and all the money they'd spent on inspections. They were trapped. They were forced to take the higher interest rate, a permanent financial consequence born from a temporary market swing they didn't even know they were exposed to. So why does this happen? It's not always the lender being evil, though some are definitely opportunistic. It happens because mortgage rates aren't just made up. They are directly tied to the trading of mortgage-backed securities, or MBS, which are essentially bundles of mortgages sold as investments. The price of these securities goes up and down all day, every day, just like a stock. When the price of MBS goes down, interest rates go up to compensate, and vice versa. Think of it like a seesaw. When a lender gives you a quote, they are basing it on the current trading price of those securities. But they haven't actually secured that money for you yet. They're just showing you the price on the sticker right now. If you walk around the store for an hour and come back, the price might have changed. Unless you take that item to the register and pay for it, which in the mortgage world is called locking the rate. You are just a window shopper. The sneakiness isn't in the market changing. The sneakiness is in the lack of clear communication. Many loan officers will let you float your rate, hoping rates might dip so they can look like a hero. But they downplay the risk that rates could also spike, putting you in the terrible position that James and Maria found themselves in. So how do you protect yourself from this last-minute budget-busting bombshell? You need to understand and take control of the rate lock. A rate lock is a guarantee from the lender to hold a specific interest rate, at a specific cost in points, for a specific period of time, usually 30, 45, or 60 days. Once you are locked, it doesn't matter if the market goes crazy. Your deal is your deal. The seesaw can go up and down all at once. You're not on it anymore. Here is your playbook. First, as soon as you have a signed purchase contract on a house, you need to ask your loan officer this exact question. What is your rate lock strategy? A good loan officer will have a clear, intelligent answer. They'll discuss the current market trends, the risks of floating versus the safety of locking, and help you make an informed decision, not just let you drift. Second, you must be relentlessly clear. Ask, if I lock my rate today at 6.5% for 1 point, are you confirming that both the rate and the 1 point cost are locked in and cannot change between now and closing? Assuming we close within the lock period? Get it in writing. An official rate lock confirmation document is not too much to ask for. So you're right. This single step prevents the bait and switch on points. Third, understand the lock period. A 30-day lock is often cheaper than a 60-day lock. Be realistic about your timeline. If you have a straightforward purchase, 30 or 45 days is usually fine. But if it's a complex transaction or you know there might be delays, it's better to pay a little extra for a longer lock up front than to pay a massive fee to extend a lock that's about to expire. Ask your lender, what is the cost to extend the lock by 1 week or by 30 days if there's a delay? Knowing this cost ahead of time removes another potential last-minute surprise. Finally, for those in a particularly volatile market, you can ask about a float-down option. This is a special type of rate lock. It protects you if rates go up, but if rates happen to fall significantly during your lock period, you get to take advantage of the lower rate. This option usually costs a little extra, but it's like having insurance. It's the best of both worlds. You're protected from the upside risk while still having a chance to benefit from the downside. By taking control of the rate lock process, you take the lender's secret weapon and turn it into your shield. You move from being a passenger subject to the turbulence of the market to being the pilot who has locked in their flight plan. But the lender isn't the only one with hidden costs. Once you've locked your rate and secured your financing, you might think you're safe. But at the closing table, another entity emerges from the shadows, demanding thousands of dollars for a service you've probably never even heard of. It's not for the house, it's not for the loan. It's an insurance policy against the past. A fee to protect you from the financial ghosts of everyone who has ever owned your property before you. And if you don't pay it, you don't get the keys. Period. We're breaking down this mandatory mystery fee. Next. This mandatory mystery fee is called title insurance. And it's one of the most misunderstood, yet critically important closing costs you will ever pay. It's not like your homeowner's insurance, which protects you from future events like a fire or a flood. No, title insurance is completely different. Protects you from the past. It's a legal shield against events that have already happened, long before you ever saw the Zillow listing. So what exactly are these financial ghosts we're talking about? They're called title defects or clouds on the title, and they are legal landmines buried in the property's history. Imagine this. You buy your dream home, you move in, you paint the walls, you start your life. Then 6 months later, you get a knock on the door. It's a contractor who claims the previous owner never paid him for the new roof he installed 2 years ago. He has a legal claim against your property, a mechanic's lien. And now, he wants you to pay him $30,000, or he can force the sale of your house to get his money. Or what about this? A distant, long-lost heir of the person who owned the house 50 years ago suddenly appears, claiming the property was never legally sold, and that they are the rightful owner. They have a faded but legally valid will to prove it. Or maybe the city discovers that a previous owner built your beautiful back deck without a permit, and now they're ordering you to tear it down at your own expense. These aren't made-up horror stories. They are real-world scenarios that can and do happen. Forgery, undisclosed easements, clerical errors in public records, unknown spousal claims from a messy divorce decades ago, an unpaid tax lien from the IRS. The list of potential historical problems is terrifyingly long. Any one of these issues could jeopardize your ownership of the property, potentially costing you tens of thousands of dollars in legal fees, or, in the worst-case scenario, costing you the house itself. But wait, you're probably thinking, didn't the title company do a title search? Isn't that what I paid for? Yes, they did. A title search is like a background check on the property. They scour public records, deeds, and legal documents to try and uncover these very issues. But here's the critical part. A title search is not foolproof. People make mistakes. Documents get misfiled. Forgeries can be incredibly convincing. Some issues are simply impossible to find in the public record. The title search finds the known threats. Title insurance protects you from the unknown ones, the legal boogeyman hiding in the closet. Now, this is where it gets a little more complex because there isn't just one type of title insurance. There are two, and you need to understand the difference because one is for your lender, and the other is for you. First, there's the lender's title insurance policy. This one is not optional. Your mortgage lender will require you to purchase this policy as a condition of giving you the loan. Why? Because the lender has a massive financial stake in your property. Until you pay off that mortgage, they are a primary owner in a sense. This policy protects their investment, and their investment only. If a title issue pops up and threatens the ownership of the home, the lender's policy ensures that they will get their money back. It protects the lender from losing their principal if you have to default on the loan because of a title claim. But notice who I said it protects, the lender. This policy does absolutely nothing to protect your down payment, your equity, or your right to live in the home. If a major title claim surfaces and all you have is a lender's policy, the bank might be made whole, but you could be left with nothing, out on the street with your down payment gone forever. This is why the second type of policy is so important. The owner's title insurance policy. As the name implies, this one protects you, the homeowner. It protects your financial interest in the property. It covers your down payment and your growing equity. If a title claim arises after you close, the owner's policy is what pays for the lawyers and the court costs to defend your title. It's what pays to fix the problem, like paying off an old lien. And if the fight is unwinnable and you lose the house, the owner's policy is what reimburses you for your financial loss, up to the full purchase price of the home. Now, here is the single most dangerous trap you can fall into at the closing table. In most states, the owner's title insurance policy is technically optional. The closing agent will present it to you as a choice. You've already seen the massive list of fees, your head is spinning, and suddenly someone offers you a way to save $1,000, $2,000, maybe $3,000 just by checking no on a box. It's incredibly tempting. Do not do it. Declining owner's title insurance is one of the single biggest financial mistakes a homebuyer can make. It is the definition of being penny-wise and pound-foolish. You are leaving your single largest asset, and all the money you've poured into it, completely exposed to decades of other people's mistakes, forgeries, and forgotten debts. Unlike homeowner's insurance that you pay every year, title insurance is a one-time fee. You pay it once at closing, and the policy protects you for as long as you or your heirs own the property. Think about that. For a single payment, you get a lifetime of protection against catastrophic financial loss from the past. When you frame it like that, it's arguably the best insurance deal you'll ever get. So how much does it cost? The price is typically regulated at the state level and is based on the purchase price of your home. The more expensive the home, the higher the premium. It can range from a few hundred to a few $1,000s. And since it's a regulated industry, you might think the price is the price and you can't do anything about it. But that's not entirely true. While the rates themselves are often set, the service fees charged by different title companies can vary. You absolutely have the right to shop around for your title company, just like you shopped for your lender. Get quotes from a few different providers. And here's a pro tip that can save you a significant amount of money. Ask for the reissue rate or reissue discount. If the home you're buying was sold within the last few years, typically 10 years or less, it means a title insurance policy was already issued for it recently. Because the title company doesn't have to search back as far, they can offer you a substantial discount on your new policy, sometimes as much as 40% off. Many homebuyers don't even know this exists and they don't ask. You should always ask. Title insurance is the price you pay for peace of mind. It's the fee that lets you sleep at night, knowing that no matter what legal skeletons are buried in your property's past, your ownership is secure. It transforms a house from a collection of deeds and legal risks into your home. But your lender and the title company aren't the only ones with their hands out at the closing table. There's another major player waiting to collect their share. This next category of fees isn't for a service or a policy. It's not for protection or paperwork. These are the fees you pay simply for the privilege of the transaction itself. The taxes and government charges that Uncle Sam and your local county demand before they'll put your name on that deed. These are the unavoidable costs of bureaucracy, and they can add up faster than you think. We're getting into the government's cut next. First up is the government's toll booth on the road to homeownership. Transfer taxes. Think of it like this. You're not just buying a house, you're buying a legal title, a piece of paper that says this slice of America is now yours. And for the privilege of transferring that title from the seller's name to your name, the state, county, or even the city wants its cut. This isn't a small fee either. It's often one of the largest single closing costs you'll face, and it's calculated as a percentage of the home's sale price. So, on a $400,000 home, a transfer tax of just 1% is $4,000. Poof, gone. And in some areas it's much higher. So who pays this hefty tax? Well, that's where it gets messy and where a good real estate agent earns their commission. The rules are a chaotic patchwork that changes from state to state, and sometimes from one town to the next. In some places, the seller is legally obligated to pay. In others, the buyer is on the hook. And in many areas, it's completely negotiable, becoming a major bargaining chip in the offer process. Let's imagine you're buying a home in a state where the transfer tax is customarily split 50-50. You've budgeted for everything. You've got your down payment, your lender fees, your inspection costs. You're ready. But the seller is tough. They refuse to pay their half of the transfer tax. Suddenly, you're staring down an extra $2,000 bill you never anticipated. This is why you have to know your local customs inside and out. Don't just ask your lender. Ask your real estate agent. Who typically pays the transfer tax here? And what can we negotiate? Because a single sentence in your purchase offer, seller to pay all transfer taxes, could save you thousands of dollars right at the finish line. It's a fee hidden in plain sight. A silent giant that can take a huge bite out of your savings if you're not prepared for the fight. Now, once the government has taken its big chunk with the transfer tax, it comes back for a smaller bite with something called recording fees. This one feels a bit more reasonable, but it's just as non-negotiable. After you sign that mountain of paperwork, the title company doesn't just put your deed in a filing cabinet. They take it down to the county recorder's office, the official keeper of property records, to make your ownership part of the public record. This is a profoundly important step. It's the official ink that tells the world this property is yours. It prevents the previous owner from trying to sell it to someone else tomorrow. It's the bedrock of our entire system of land ownership. And for this service, the county charges a fee. Usually, it's a small amount per page of the document being recorded. You're not just recording the deed, you're also recording the mortgage document, which gives the bank a legal claim, or lien, against your property. So, if your deed is 2 pages and your mortgage is 20 pages, you're paying to record all 22 pages. The total cost might only be $100 or $200, but it's another one of those mandatory charges that adds to the pile. It's the cost of bureaucracy, the price of making your homeownership story an official part of your town's history. It's not a fee you can shop for or negotiate, but you need to see it on your estimate and budget for it, because without it, the sale isn't legally complete. But now we arrive at the one government-related charge that shocks more first-time homebuyers than any other. It's not a fee, and it's not technically a tax you pay at closing. It's a prepayment. I'm talking about property taxes and the creation of your escrow account. This is a financial gut punch for the unprepared. So listen closely. You know you have to pay property taxes every year, but the lender has a deep-seated fear that you won't. If you fail to pay your property taxes, the county can put a lien on your home that is superior to the bank's mortgage. In a worst-case scenario, the county could foreclose and the bank could lose its entire investment. They are not going to let that happen. So, to protect themselves, most lenders require you to have an escrow account, sometimes called an impound account. Here's how it works. Every month, your mortgage payment will actually have 4 parts, remembered by the acronym PITI: principal, interest, taxes, and insurance. The bank takes the T and the I, your estimated monthly property tax and homeowner's insurance payments, and puts them into a separate savings account, your escrow account. Then, when the big property tax bill and insurance premium are due once or twice a year, the bank pays them for you out of that account. It's forced savings to make sure the essential bills get paid. But here's the kick in the teeth. The bank can't start an escrow account with a zero balance. They need a cushion. By law, they're allowed to keep a buffer in there, typically equal to 2 months of escrow payments. So, at the closing table, you are required to make the initial deposit to fund this account. Let's run the numbers. Say your annual property taxes are $6,000. That's $500 a month. And your homeowner's insurance is $1,200 a year, which is $100 a month. Your total monthly escrow payment is $600. The lender will likely demand a 2-month cushion, which is $1,200, right at closing. But wait, it gets more complicated. Property taxes are paid in arrears, meaning you pay for the time you've already been in the house. The seller has been living in the home for part of the year, so they owe taxes for that period. You will own it for the rest of the year. This all has to be settled at closing through a process called proration. For example, if you close on July 1st, exactly halfway through the year, the seller is responsible for the first 6 months of taxes. They will typically give you a credit at closing for their share. So you'll see a line item that says, seller credit for taxes, which looks great. But then a few lines down you'll see the massive charge for your escrow account. The lender will look at when the next tax bill is due and calculate how much they need to collect from you, now to ensure there's enough money in the account to pay it. This could be 3, 4, even 6 months worth of property tax payments, plus that 2-month cushion. It is not uncommon for this single line item, your initial escrow payment, to be $3,000, $4,000, or even $5,000. It's your money and you'll get it back if you ever sell the house, but you have to come up with it in cash right now on closing day. This is the #1 reason buyers experience sticker shock at the closing table. They see the lender fees, they see the title fees, but they completely forget that they have to prepay a huge chunk of their first year's property taxes and insurance. It's a massive upfront cash requirement that feels like a fee, even though it's technically just pre-funding your own savings account. It's the government's reach, filtered through your lender's paranoia, and it lands squarely on your closing statement. So we've dissected the lender's cut, the third-party reports, the title insurance maze, and now the government's take. You now understand the anatomy of closing costs, from the biggest charges to the smallest administrative fees. But knowing what these fees are is only half the battle. The real power comes from knowing which ones you can challenge, which ones you can negotiate, and how to spot the outright errors on your closing disclosure that could save you thousands. The final battle for your wallet happens in the last 48 hours before you sign. When you get that final document in your hands, I'm going to show you exactly how to win it. That document is called the Closing Disclosure, or CD. It's a 5-page government-mandated form that is supposed to make everything crystal clear. But in reality, it's often a dense, confusing mess of numbers that arrives when you are at your most vulnerable, excited, stressed, and exhausted. Most homebuyers are so relieved to be at the finish line that they just skim it, initial where they're told, and sign. That is a catastrophic mistake. This document isn't a formality. It's the final invoice for the biggest purchase of your life. And it is your last best chance to catch the errors, overcharges, and junk fees that can cost you thousands. So, grab a copy of your initial loan estimate, the document you got right after you applied. This is your baseline, your source of truth. We're going to compare these two documents line by line, like a forensic accountant hunting for fraud. First, turn to page 1 of your closing disclosure. Ignore everything else and look at the loan terms box. Is the loan amount exactly what you expected? Is the interest rate precisely the percentage you locked in? 0.25% might seem small, but on a $300,000 loan, That's a difference of over $30,000 in interest over 30 years. Does it say yes next to can this amount increase after closing? If you were promised a fixed-rate mortgage, it had better say no. I once worked with a client, we'll call him David, who was promised a 6.5% fixed rate. His final CD said 6.625%, an eighth of a point. When he questioned it, the loan officer said, "Oh, rates just ticked up. It's a small adjustment." David, armed with his locked rate agreement, held his ground. That small adjustment would have cost him an extra $12,000. They fixed it within an hour. It wasn't a rate tick. It was a test to see if he was paying attention. Next, your monthly principal and interest payment. Is it what you were quoted? If it's different, you need to know why down to the penny. Then look at the projected payments section. This is where they add in your escrow for taxes and insurance. These numbers can and do change, but do they make sense? Is the homeowner's insurance premium the same as the quote you approved? Are the property taxes in line with the county's assessment? A simple typo here, an extra zero, could inflate your monthly payment by hundreds of dollars until it's caught, which could be months later. Now let's flip to page 2. This is the battlefield. This is where the hidden fees live. You'll see a column for loan costs and other costs. We're going to focus on the loan costs first, specifically Section A, origination charges. These are the fees your lender is charging you directly to create the loan. Application fee, processing fee, underwriting fee. Here's the critical rule you have to know. These fees have zero tolerance. That means they legally cannot increase from what was on your original loan estimate. Not by $1. If your loan estimate said the underwriting fee was $800, and your closing disclosure says it's $850, that is an illegal charge. You need to call your loan officer immediately and tell them to remove it. They will. They have to. Next, look at Section B. Services you did not shop for. These are third-party services the lender requires and chooses for you, like the appraisal, the credit report, and the flood certification. These fees have a 10% tolerance. Here's how that works. You add up all the fees in Section B on your original loan estimate. Let's say it was $1,000. Then you add up the same fees on your closing disclosure. The total on the CD cannot be more than 10% higher than the original estimate. So in our example, if the total is now more than $1,100, the lender has to cover the difference. They are banking on you not doing the math. Do the math. Now Section C. Services you did shop for. This is for things like your title insurance, pest inspection, and survey. If you use the providers recommended by your lender, the same 10% tolerance rule applies. But if you chose your own providers, which you should always try to do, then the fees just need to match the quotes from those companies. The most common error I see here is duplicate or padded title fees. You'll see charges for title search, title examination, title binder, and lender's title insurance. Sometimes these are all legitimate and separate, but often they are just different names for the same service, allowing the title company to double dip. Question every single line item. Ask for a definition. A legitimate professional will have no problem explaining their fees. Someone trying to pull a fast one will get defensive. That's your signal to dig deeper. Okay, let's move down to page 3. This is the calculating cash to close table. This is the final gut check. It shows all the money moving around. The most important lines to check here are your earnest money deposit and any seller credits. I cannot tell you how many times a $5,000 seller credit that was negotiated for repairs just disappears from the paperwork. It's not malicious. Usually, it's a communication breakdown between the real estate agents and the lender. But the result is the same. You're $5,000 poorer. Verify your earnest money deposit is credited correctly. If you put down $10,000, make sure it shows a $10,000 credit. It sounds basic, but in the frantic rush to close, these are the details that get missed. So what do you do when you find one of these errors? First, do not panic. This is normal. Second, do not wait until you're sitting at the closing table. The moment you get the CD, you have a 3-day review period by law. Use every second of it. The instant you find a discrepancy, draft an email. Put your loan officer and your real estate agent on it. Be polite but firm and specific. Don't say the fees look high. Say, on page 2, Section A, the processing fee is listed as $600. My loan estimate from May 15th lists this fee as $400. As this is a zero tolerance fee, please correct the disclosure and send a revised copy. This creates a paper trail and shows them you know the rules. If they push back, If they give you excuses about standard adjustments or system glitches, hold your ground. Remind them of the TILA-RESPA Integrated Disclosure Rule, or TRID. That's the federal regulation that governs these forms. You don't need to be an expert, you just need to use the name. It shows them you've done your homework. 99% of the time, the fee will magically be corrected. For that last 1%, you tell them you will not be signing at closing until a correct CD is issued. The threat of a delayed closing is powerful leverage, because everyone in the transaction, the lender, the agents, the seller, only gets paid if you sign. You have spent months, maybe years, saving for this moment. You've sacrificed, you've planned, you've dreamed. Don't let a few preventable errors in the final hours rob you of your hard-earned money. You are the client. You are the customer. You are the one bringing hundreds of thousands of dollars to the table. You have all the power in these final days. This isn't just about avoiding fees. It's about taking control of your financial destiny. This home is the foundation of your future wealth, and that foundation begins with a fair, transparent, and accurate closing. You've now learned how to defend your wallet against the hidden fees and errors that plague the mortgage process. But defense is only half the game. What if you could go on offense? What if you could get the seller to pay thousands of dollars of your closing costs for you? It's not only possible, it's a negotiation strategy that savvy buyers use every single day to save a fortune. In my next video, I'm breaking down the exact scripts and tactics to negotiate seller concessions, even in a competitive market. So make sure you're subscribed with notifications on, because mastering the closing is one thing, but making someone else pay for it, that's a whole different level of winning.